Fluor Corporation, ticker symbol FLR, strongly beat consensus estimates for Q2 2026.
Yeah, I mean, the top line came in at $4.33 billion in revenue, which easily beat that $3.92 to $3.96 billion consensus. That's a jump of roughly 9% year over year.
And the bottom line just absolutely crushed it. Adjusted earnings per share hit 91 cents, completely blowing past the 70 to 73 cent consensus. I mean, that is a 112% increase year over year.
Right, and looking ahead, management adjusted their full year 2026 adjusted EBITDA guidance to a range of $500 million to $525 million, which is down slightly from prior estimates, but strictly due to a joint venture divestiture. Meanwhile, adjusted EPS guidance for the full year was maintained at $2.70 to $2.80.
And the market reaction was just immediate. Shares jumped 12.6% in pre-market trading, opened at $54.50, and closed the regular session up 10.36% at $53.80, hitting a brand new 52-week high in the process. Okay, let's unpack this. We are diving into Fluor's Q2 earnings report, the analyst notes, and management's commentary today.
Yeah, and our mission here is really to figure out if this legacy construction giant has, actually fixed its historically broken business model, or if these numbers are just a flash in the pan.
Exactly. Because reading through this report, it feels exactly like a company finally ripping the plastic off the furniture after a massive, messy, multi-year home renovation. It signals to you, the retail investor, that the defensive cleanup phase might actually be over. The turnaround is complete.
It really does feel that way. For years, the narrative around this company has been completely dominated by legacy problem projects, massive cost overruns, and just painful portfolio restructuring.
Right.
But these Q2 numbers represent a very clear inflection point. You simply don't see a legacy engineering and construction firm double its earnings per share year over year unless something fundamental has shifted in how they execute, and more importantly, how they recognize profit.
So we know the headline numbers were a blowout, but how did they actually pull off that 112% jump in EPS? To understand that, we need to look under the hood at the segment level, right?
Yeah, absolutely.
Because the performance was definitely not uniform across the board, the top-line hero of the quarter was clearly Urban Solutions.
Oh, without a doubt. Urban Solutions is where the bulk of the revenue growth materialized. I mean, they surged over 40% year over year to $2.9 billion, which just handily beat the $2.45 billion estimate.
Wow, 40% is massive for a company this size.
It is. And that was fueled by a huge ramp-up in execution activities. Specifically, we're seeing intense momentum within the mining and metals markets, alongside, significant contributions from their life sciences projects.
Right.
When a segment expands its top line by 40% in a single year, it tells you that client capital expenditures in those specific end markets are actively being deployed right now. The clients aren't just planning antides. They're putting shovels in the ground.
Wait, hold on, though. You're praising the top-line growth there, but then we look at Energy Solutions. Revenue in the energy segment actually dropped 38% year over year, down to $709 million, which missed Wall Street estimates.
Yeah, it did drop.
Yet somehow, this shrinking segment generated $88 million in profit. I mean, isn't that a massive red flag? It feels like the underlying shrinkage of a core business unit is just being masked by a temporary margin spike. Like, are they actually losing ground in the energy space?
What's fascinating here is that the revenue drop isn't a sign of lost market share at all. It's purely a function of project life cycles.
Okay.
While the revenue dropped, the profit margins in Energy Solutions spiked from a meager 1.3% a year ago to a massive 12.4% this quarter. That massive margin spike was driven by highly favorable closeouts and subcontractor settlements on multi-year mega projects.
Okay, let's break that down for the listener who maybe doesn't live in the weeds of construction accounting. How does a project finishing up suddenly cause a profit margin to jump tenfold in a single quarter?
Yeah, it sounds weird, right?
Yeah.
But in construction accounting, when a company takes on a massive multi-billion-dollar, multi-year project, they don't recognize all the profit evenly along the way.
What?
They hold back a chunk of cash, a contingency fund, just in case something goes wrong, like maybe steel prices spike, or a subcontractor fails, or there are unexpected weather delays.
So it's basically a rainy day fund for the project.
Exactly. And if they manage the project well, finish the work, and nothing catastrophic happens, those just-in-case funds are no longer needed. When the project finally crosses the finish line and they finalize all the settlements, all those millions of dollars in unused contingency funds are released. They drop straight to the bottom line in a single quarter.
Oh, I see. So it's essentially deferred gratification. They are getting paid out for years of disciplined execution all at once.
Spot on. It proves they are finishing their old work profitably, which is the ultimate goal. However, and this is important, management warned on the call that these margins will naturally normalize in the back half of the year.
Ah, so it won't stay at 12%.
Yeah, right. As they shift away from these highly profitable project closeouts and start ramping up early-stage work on new projects, the margins will compress back to typical industry standards. Early-stage work just doesn't carry 12% margins.
Okay, so if Energy Solutions is giving them this wild, unpredictable margin spike from old projects closing out, where is the stability? Like, how do they balance that risk across the whole company?
That leads us straight into their Mission Solutions segment, which is primarily their government work. They brought in $716 million in revenue and $44 million in profit this quarter.
Which is, what, around a 6% margin?
Yeah, solid 6.1% margin. And that was aided by improved award fee performance across their Department of Energy portfolio. Mission Solutions provides a recurring, predictable baseline of revenue. Having that anchor allows management to take calculated risks and absorb the lumpiness in those other commercial segments.
Right. Knowing they have that steady baseline makes their next move make a lot more sense. Let's talk about what they are intentionally cutting loose. Because the biggest strategic move in the quarter was the sale of their equity in the Fluor joint venture in Mexico for $175 million.
Right, which generated a $90 million pre-tax book gain.
But wait, this is also what caused them to narrow their full-year guidance, right?
Yeah, and the mechanics of that guidance change are crucial to understand here. Normally, when you see a company beat on earnings but lower or narrow their full-year EBITDA forecast, the market just punishes the stock.
Because investors assume something is broken in the core business.
Exactly. But here, the stock rallied over 12%. The slight drop in full-year EBITDA guidance down to that $500 to $525 million range wasn't an operational downgrade at all.
They just surgically removed the future earnings of the asset they sold.
Exactly the case. It was simply the mechanical removal of $23 million in expected second-half earnings from that Mexican joint venture. Investors looked right past the headline revision because they understood it was a strategic portfolio reconstitution.
Makes sense.
They get an immediate $175 million cash infusion and exit a market where they saw diminishing prospects, which, allows them to redeploy that capital elsewhere.
And that ties perfectly into the other major cleanup effort, sunsetting the legacy projects. We have talked about these problematic lump sum contracts for years, and it looks like they are finally at the finish line.
Yeah, the remaining legacy backlog is now down to a mere $119 million.
That's practically nothing for them. Projects that have historically been major drags on profitability, like the LBJ and Oak Hill Parkway projects in Texas and the Red Purple Line in Chicago, are now completed or substantially advanced.
It is hard to overstate how important this is for the company's risk profile. They are systematically removing the downside risk that has plagued the stock for the last half-decade.
So, what does this all mean? If you think about the business like a mature tree, the Mexico joint venture sale and the wrap-up of these legacy projects are basically aggressive pruning. They are intentionally cutting off the dead or slow-growing branches.
That's a great way to look at it.
Right. They take a little temporary hit to the overall size of the tree, but it allows them to redirect all the water and nutrients to the fastest-growing, healthiest parts of the business.
The strategic pivot taking place is just profound. The conversation internally and among analysts has entirely shifted from backward-looking cleanup to the forward-looking pipeline, and the numbers backing up that pipeline are staggering.
Yeah, let's get into those.
They booked $6.1 billion in new awards in the second quarter alone. Just to put that in perspective, a year ago they booked $1.8 billion in the same quarter.
That's a massive jump.
And their total backlog now sits at $26.9 billion.
But honestly, the size of the backlog isn't even the most important part for the retail investor listening to this. It's the composition of that backlog. Management noted that 85% of this $26.9 billion is reimbursable. Let's dig into why that matters so much, because this is a massive structural shift from the old days that got the company into trouble in the first place.
Oh, absolutely. If you're holding FLR stock,
Yep.
This shift to reimbursable contracts is arguably the most important data point in this entire earnings report.
Really, more than the EPS beat.
I'd say so, long term. In the past, engineering firms relied heavily on fixed price or lump sum contracts, so the firm bids $1 billion to build a bridge. If inflation hits or the supply chain breaks down and the bridge ends up costing $1.2 billion to build, the contractor eats that $200 million loss.
Yeah.
It wipes out quarters of profit.
It's essentially gambling on macroeconomic stability over a 5-year timeline, which is impossible.
Right. But in a reimbursable contract, the client assumes the risk of inflation and supply chain disruptions. The contractor gets paid for the costs incurred, plus a fee or margin on top.
That is so much safer.
By moving 85% of their backlog to reimbursable terms, Fluor has fundamentally de-risked their future revenue stream.
Yeah.
The days of waking up to a surprise massive loss on a single project because the price of concrete went up, those days are virtually over.
Okay, so they have a massive de-risked backlog. Where is all this growth actually coming from? Management laid out a few specific growth vectors on the call, and the first one is data centers and power.
Yes, a very hot sector.
But frankly, literally every company on Wall Street right now is hyping up data centers and AI power demands to get a bump in their stock price.
Yeah.
Are these just buzzwords being thrown around on an earnings call, or is there real, tangible backlog being generated here that fits their actual expertise?
If we connect this to the bigger picture, you can see that it's not just hype because of how disciplined their approach is. Management isn't trying to build the server farms themselves. They are focusing on the core bottleneck of the AI revolution, which is power generation. They are currently executing front-end designs for combined and single-cycle gas projects. And they're advancing work for TeraWulf's data center in Kentucky, providing project management and engineering services while negotiating the EPC contract.
Wait, before we move on, you mentioned EPC contracts and combined and single-cycle gas projects. For the listener who doesn't build power plants for a living, what exactly do those terms mean in terms of Fluor's actual day-to-day work?
Sure, yeah. EPC stands for engineering, procurement, and construction. It means Fluor designs the facility, buys all the materials and equipment, and then actually builds it. It is the full life cycle of a massive project.
Got it. And the gas projects.
Right. When we talk about combined and single-cycle gas projects, we are talking about highly efficient natural gas power plants. Data centers require a massive, uninterrupted flow of electricity. You can't run an AI server farm on intermittent solar or wind alone. You need baseload power.
Makes sense.
Natural gas plants provide that immediate, reliable power. Fluor is designing these specific power plants to sit right next to or directly feed these new data centers.
And their discipline in how they take on this work is what really stands out to me. The company is actively refusing to take on lump sum risk for these data center power projects until the commercial terms are fully de-risked and the engineering is mature.
Exactly.
They engage in front-end design work first, which is highly profitable and low risk, and only convert that to a full EPC construction contract when the terms are favorable to them. They aren't just chasing buzzwords, they are executing a highly selective strategy.
And that capital discipline carries directly over to their second major growth vector, which is nuclear. The global push for baseload, carbon-free power plays perfectly into Fluor's historical strengths.
Yeah.
And this isn't just a conceptual pipeline either. They actually booked the EPC contract for the Centrus Nuclear Fuel Enrichment Facility this quarter.
And they are expanding into small modular reactors, or SMRs, with partners like NuScale and X-Energy, which is fascinating because instead of building a massive, custom $20 billion nuclear plant that takes 15 years, SMRs are designed to be built in factories. They're shipped to a site and assembled much faster and cheaper.
Exactly. And Fluor is positioning itself to be the premier builder of these next-generation reactors. Plus, they are preparing detailed cost estimates for traditional commercial nuclear expansion, like the Cernavoda project in Romania.
Okay, so that's power and nuclear. What's the third vector?
Beyond those, a third vector is mining and metals. Management revealed an in-house pipeline of potential awards totaling $30 billion over the next 18 months. And that's heavily focused on copper and fertilizers.
Which makes sense.
Yeah, copper is the absolute backbone of electrification. You just can't build EVs, power grids, or data centers without it. And fertilizers are essential for global food security. When you combine natural gas power generation, nuclear, and copper, you're essentially looking at an infrastructure supercycle portfolio.
But as an analyst, looking at a beautiful pipeline of future work doesn't mean much if the foundation of the house is currently leaking cash. Let's do the reality check here, because if you just glanced at the headline financial statements, the cash flow number would stop you in your tracks.
Oh, yeah.
Operating cash flow for Q2 was a seemingly terrifying negative $317 million.
I know. On the surface, burning over $300 billion in a single quarter while reporting record earnings looks like a massive accounting red flag. But if you dig into the footnotes, this was entirely driven by a pre-telegraphed $357 million tax payment.
Ah.
Yeah, it was tied to the Niscale share conversion from earlier in the year.
We should probably explain this Niscale situation for context.
Hmm.
Fluor essentially birthed Niscale, the SMR company we just talked about, and held a massive stake in it. When they converted their shares earlier this year, it triggered a massive taxable event. Here's where it gets really interesting. Think of that negative cash flow like drawing the pay the luxury tax card at the very end of a winning game of Monopoly. It hurts to hand over the cash to the bank, but it's a one-time penalty for a transaction that ultimately benefited your overall position on the board.
That is exactly what it is.
Yes.
And if you strip out that one-time tax hit, the normalized operating cash flow for the core business was actually a positive $40 million. So the underlying business is generating cash, not burning it.
Okay, that's a relief.
However, the quarter definitely had some operational bruises.
Yeah.
We have to talk about the Gordie Howe Bridge project.
Yeah, the legacy projects aren't entirely pain-free yet. Urban Solutions took an additional $44 million loss this quarter on the Gordie Howe Bridge.
And that loss was driven by just a cascading series of unfortunate events. There were foreign exchange impacts, a specific subcontractor bankruptcy, and client-driven changes. Yeah. When a major subcontractor goes bankrupt on a fixed-price job, the prime contractor, in this case, Fluor, has to step in, find a replacement at a premium, and absorb the scheduled delays. While the bridge is now structurally complete, resolving these complex commercial disputes still costs money and weighs heavily on segment margins. It is a stark reminder of why management has been so desperate to pivot away from these fixed-price mega projects.
Looking ahead, there are other notable realities on the horizon, too. Management explicitly called out that Energy Solutions margins will face pressure later in the year.
Right, as expected.
Yeah, as they pivot from those highly profitable project closeouts we talked about earlier to ramping up early-stage heavy lifting work on massive new projects like LNG Canada Phase 2, those margins will naturally compress.
Furthermore, the company highlighted that they are closely monitoring geopolitical tensions in the Middle East. While their backlog is de-risked from a contract perspective, global supply chains are still fragile. Any escalation could impact the delivery of massive industrial components or alter the timing of future mega awards in that region.
So you have a company that has successfully navigated a brutal turnaround, cleared out its legacy backlog, shifted to reimbursable contracts, and built a massive pipeline in the hottest sectors of the economy. But they still have to prove they can execute this new backlog day in and day out without repeating the mistakes of the past.
Which leaves us with one final major strategic question for the quarters ahead. Fluor ended July with a massive $3.2 billion in cash on the balance sheet.
That is a ton of cash.
It is. They have authorized $1.4 billion in share repurchases for the year, and they aggressively deployed $300 million of that in Q2.
Yeah.
But even with the buybacks, they are sitting on an absolute war chest.
Right.
With a pristine balance sheet and the legacy projects finally in the rearview mirror, could this company transition from being a defensive turnaround story into an aggressive, opportunistic acquirer?
Specifically, could we see them use that cash to buy specialized engineering firms in the high-margin nuclear or life sciences space to accelerate their growth even further?
That is the multi-billion-dollar question right there. The plastic is off the furniture, the renovation is done, and now they have the cash to start buying the neighboring houses. It's going to be a fascinating narrative to track. Make sure you follow the show for our daily earnings coverage so you don't miss our updates as this strategy unfolds.